Welcome to It Depends, a sales tax podcast by TaxConnex. I'm your host, Brian Greer, joined by my colleague, Jeff Meggs, and we're super excited that you've joined us today. Sales and use tax can be confusing and overwhelming, but it doesn't have to be. Whether you work in an industry or a CPA firm, or just someone who wants to stay informed about the latest sales tax laws, we've got you covered. Periodically, we'll explore different aspects of sales tax. So whether you're a tax pro or a novice, in industry, school, or a practicing CPA, tune in and join us as we attempt to simplify the complexity of the sales tax world. This is It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends. I'm Brian Greer. Just a little bit of background on our business here, but talking about TaxConnex a little bit more specifically, we do focus in this sales and use tax industry. We're kind of wacky from that perspective that we've made a career out of doing nothing but sales and use tax. But within the business here, we have two primary service lines. Jeff specifically heads up our consulting service line, and within that group, we're doing a lot of projects related to helping companies understand where they have nexus, where their revenue streams are subject to sales tax. We do some exposure reviews, voluntary disclosures, and of course, today's topic, sales tax audits. The other service line that we have here at TaxConnex is a compliance outsourcing service where we essentially become an outsourced sales tax department for our clients and manage the registration, filing, remittance process, responding to notices, that type of monthly kind of administrative process. I'll quickly talk through the agenda. This is always a hot topic for us and a well-attended webinar. I think there's always concerns with audits. I think there's always a perspective that the states are hungry for cash and like to audit us, like to audit businesses. So there's always questions about, how do I get selected for audit? I don't know if there's really any one single right answer there, but we'll kind of talk through that a little bit. And also just talk through managing the audit itself, how to respond, what to do after the initial assessment comes out, what options are available even after a final assessment. We'll talk through all that. Jeff has a background as a former auditor that goes back literally decades ago. But also working in industry and working from a consulting perspective here, and not just at TaxConnex, but with other accounting and tax firms as well. So he's got a good perspective from a lot of different angles here in terms of how to manage and how not to manage audits as well. So glad that he can share his wisdom with us here today.
So as Brian said, we do get this question quite a bit. How and why are companies selected for audit? And there are a variety of reasons why companies are selected for audit. Most of the time, our clients don't know the answer as to why they were selected. Sometimes auditors will share that with you, sometimes they won't. Historically, going back a number of years, I found in my own experience that the best audit opportunities were found through audits of other companies. So I'll talk a little bit about that first, but it's not necessarily in the same order as we've got this slide here. So historically, when a company was audited, we're looking at two sides of an equation. One is their sales activity. Are they adequately charging tax where they should be and at the right rates and on the right products and services? And two, are they paying tax when they should be on their purchases of tangible personal property and services? When you look back in time, the states were heavily reliant upon self-accruals, meaning the states had little, if any, authority over interstate commerce unless somebody had a physical presence in their state. And so there tended to be a lot of business transactions whereby sales and transfers of tangible personal property took place, and the vendor was not charging tax, and it was up to the customer, the consumer, to pay that use tax. And so auditors would look at those activities and those transactions, and over time they would start to see a trend, and they would start to realize, hey, this company looks like they may be providing some services in this state. They probably have a physical presence, and I never see them charging tax on their invoice. I'm going to call them up and see what we can find out. Or it could be a vendor that's just down the street that just doesn't understand their compliance obligation and has a lot of misses on their invoices and may be inconsistent in the way they present the tax on their invoices. So they become a target. So out of every audit I would conduct, I would inevitably come out of that audit with 2 or 3 more audits. So there was a never-ending supply chain in that regard. When you look at what we have today, the economic sort of platform that we operate on is a good bit different. With the Wayfair decision in 2018, there's now an economic nexus standard, which starts to require compliance of many more companies than ever before. And the physical presence test still exists, but it's not the only test. And so I think there tends to be a lot less in the way of consumers' use tax exposure than there used to be. But I think the states are starting to get a little more active when it comes to identifying candidates for audit. And the Wayfair decision, I think, afforded them that opportunity. So we are starting to see more states send out what we call nexus questionnaires to companies, and they do sort of have a spin associated with Wayfair, associated with an economic nexus standard. And I think that net is starting to get cast and is catching a lot of good protein these days. So nexus questionnaires, audits of other customers, audits of your vendors. Prior audit history is a pretty good indicator. Certainly if you've gone through an audit and it was not a favorable outcome, or you didn't have things buttoned up and the state didn't feel like you were consistent in your application of the laws and the rules, you're probably going to get contacted within the next business cycle or audit cycle. That's typically a 36 to 48 month time frame. There's certainly what we refer to as audit cycles. And in this particular component, we're talking about the largest of the largest companies, the Fortune 1000, Fortune 500, where their activities are so significant and material, a small error rate creates a big windfall for the state. And so they almost become audited on a regular cycle. And it's not uncommon when we're representing clients of that magnitude, we'll be in the process of working through an audit, and they'll actually start the new audit while the other audit is still going on. So don't necessarily enjoy being in that place, but those sort of things happen. From time to time, states will identify or target specific industries if they feel like there's either a lack of understanding or maybe a trend of companies making independent decisions or interpretations of the law on a more consistent basis across companies in the same industry. And so they may spend some time in that industry just to clean that up, or they may, in some cases, they'll go down that path and change their laws. Interesting how audits of multiple companies in the same industry, all of a sudden that news travels back upstream to the legislature, and representatives start getting a lot of phone calls, and they decide, hey, we're going to change the law. And sometimes they'll change the law retroactively to accommodate that particular industry. The last couple here, disgruntled customer employee, and I know we're going to try to talk a little bit about real world examples. I'll share with you some of my stories along the way. Sometimes I share more than than other times. But I'll share just a quick one here on a disgruntled customer and employee situation. We had a client who was operating in a multi-state fashion. They had business activities in just about every state within the continental U.S. They were facilitating a lot of their business through independent contractors, and meaning they didn't necessarily send employees into any of those states. They didn't have inventory in those states, but they did leverage local independent contractors to perform services on behalf of their customers. And that in and of itself is a physical presence within the state for sales tax nexus purposes. Meanwhile, at their executive headquarters, their CFO was engaged in some scrupulous activities, cooking the books, maybe said another way. And in addition to that, this particular individual had already responded to a number of nexus questionnaires and never disclosed these independent contractors performing these services, and did so intentionally to avoid having to comply with sales and use tax laws. Well, the company found out that the person was doing some illegal activities with regard to their accounting and finance. The FBI got involved. The person was arrested, and that person, a few weeks later, this company started getting phone calls, and they were being selected for sales tax audits. And there were 4 of them in about a span of 2 weeks. And they certainly or quickly caught on to the fact that something was going on. Ultimately, we found that this person had called roughly all the states he could think of to advise them that this company was intentionally avoiding sales tax. And so they were starting to audit them. It forced the company to have to proactively address the matter. And that's when we got contacted, introduced to the circumstances, and we had to do voluntary disclosures with 34 states to mitigate the eventuality that they were going to be identified and audited. Disgruntled customers is sometimes the same fate, except those usually end up looking like a class action lawsuit. And just last week, we were on a call with a gentleman out of Massachusetts who was representing a client who was being sued in a class action fashion around sales tax. Those are a little more comical from our perspective, because it tends to be a very minor transaction, and we're talking about literally consumers walking through a shopping aisle at Home Depot and deciding they don't like the way they were taxed, and creating that level of noise. It's a very big distraction. It's usually not a material dollar amount or material issue that way, but it can create headaches. And finally, there are definitely random audits, just like income tax. The states have to keep everybody honest, including their auditors. And so they will assign random audit selection. I say random. I'm sure there's different ways they identify companies for audit in that regard. So again, plan for the inevitable. The better equipped you are to expect an audit, the more likely you'll probably never have one. Because as you can see, those activities that sometimes lead to audit are the fashion in which you manage your sales tax compliance. And if you manage it well, you're likely not to really show up on anybody's radar.
Yeah, and Jeff, just to comment on the Nexus questionnaires, those are certainly, they've been around for a long time, even prior to Wayfair. But what we've seen, of course, over the last few years is that those are much more pointed in terms of the questions, and the measure or the standard is very clear from a Wayfair perspective. So those questionnaires tend to be asking for revenue source in the state, number of invoices in the state, and those are very clear-cut answers to allow these states to make a very quick determination as to whether someone might have nexus or not. But definitely be on the lookout for those. So
now that we've been selected for audit, there's a number of sort of thoughts that goes through everyone's mind. I think there is a tendency to sort of assume the worst. And when I say assume the worst, these audits are generally just processes. I wouldn't consider them the same as getting pulled over for speeding when you're driving down the road. We know that when that happens to us, our blood pressure rises a little bit. We get a little bit nervous. I don't think it's necessary to have that level of angst around it, but certainly if you're not prepared, you're going to feel some of that. So that's undoubtedly the case. One of the things that we try to do before an audit even starts is think about, are we consistent in our application of sales and use tax? So we've got an audit indicator. We've got a letter from the state saying they intend to audit the books and records. Our immediate approach should be, okay, well, let's just see, is there anything that we're really concerned about? So the consistency of that process, we find that companies are regularly going through changes to their ERP and also changes to their sales tax calculation processes, some more sophisticated than others, but any level of change in that regard can lead to some real significant issues. You want to always have available data, and that doesn't necessarily need to be in a physical fashion, but you need to have access to a good set of data, be able to query that data as necessary for a particular audit. The querying ability is as important as the availability of the data, because you don't want to provide more than the auditor has asked for. That tends to be sort of the default for a lot of our clients, is they get an audit request, they don't want to take the time to try to bifurcate the data elements, and so they'll just provide the entire data set. Sometimes that doesn't cause a problem, but what it does cause sometimes is unnecessary issues, because you're dealing with an auditor who isn't going to understand your business, isn't going to try to understand your business, and is going to take the easiest way out relative to doing their assessment. And so the more data, the more visibility to transactions and volume and materiality they get access to, the more likely you'll have some erroneous assertions of taxability. As a result, we also want to understand, if there is risk, is it compartmentalized? Is there a way that this can be sort of blended in? I don't want to use the term hidden, because that implies we're going to do something proactive and remove the data set from what the auditor sees. We're not suggesting that at all. But certainly when there are circumstances or issues that exist that are known, the way we present the overall data can influence whether or not those items are identified. One of the things that almost always happens when you're audited is you get the initial audit inquiry or the audit notice, and it'll be typically in a written format, and they will ask for 2 pages worth of data. You'll have 20 or 30 bullet points of data sets that these auditors are asking for and requesting. Understand that they come at this audit from a standard program that everybody's got to follow, and most of that data they're asking for is primarily to just confirm that you're providing them with 100% of the data that they need to see. So it's validating, it's reconciling between multiple data points and triangulating around the data elements to a degree that they're confident that nothing's missing. Everything's within their review process, and they're adequately equipped with what they need.
And Jeff, when you're talking about data, you're talking about not just like actual data in a file. You're talking about bank records they might ask for, tax return copies, all this other stuff, not just physical, like
exactly.
Excel data.
Yeah, the GL detail. There's quite a bit of stuff that gets asked for. Those are some basic things that we always advise our clients to provide. Income tax returns, you might as well provide them. You're not going to avoid that. And they're easy to provide. And frankly, they already have access to them. And so I like to think about the things that I can provide quickly in response to those initial audit requests, and go ahead and push some of that information to the auditor quickly. Show an effort and an initiative to want to comply. Anything I don't want to show them, I'm going to hold back, and I may sort of trickle data to them over the course of time. More often than not, by the end of the audit, they've forgotten about that other data set or sets. It wasn't important anyway, wasn't necessary. Sometimes I don't provide it just because of the hassle of pulling it together. It's not always because it shows information I'd rather them not see. It's just the overwhelming cost of managing the audit. As you meet with the auditor, in today's world, most of those meetings are virtual. You want to be able to give a clear picture of both the business activity and the compliance process. You want to make it a short and consistent message or theme across both. And you want to gear your conversation towards what is working well. I equate it to if I was selling my house and I put the for sale sign out in the front yard, somebody knocks on the door, I'm going to show them all of the great features and great things that really shine and work well in my house. I'm not going to point out any of the leaks or rusty pipes or creaky floors. Doesn't mean they can't see them or find them or identify them, but I'm going to focus them on the areas that are well maintained and function appropriately. So that initial examination period, being selected, there's a few things you can do, and just keep in mind you have a good bit of time between the time you get notified of an audit and the time things start to become real and you start having to provide the actual data. So now that we've kind of gotten ourselves inside of this audit process, it's imminent that the audit is going to happen. There's still a number of things and strategies that can be employed. Not the least of which is setting the appropriate sample period. I will tell you that the evolution of technology has actually started to take its roots with the state and local governments. That took them a while to catch up. So we do see a lot of states, the more modern states are leveraging more of a statistical audit approach, computer-assisted audits. In fact, what they'll do a lot of times is there'll be an auditor on the face of the audit, and there'll be a computer specialist behind the scenes, sometimes visible, sometimes not, who's really driving what set of data they're going to require, how they're going to accumulate it, and how they're going to project it. So one of the challenges that we have faced with some clients is when they have made a significant change in their ERP system, they've got two periods. The audit spans a period pre-ERP change and post-ERP change. And they may have awareness that the pre-ERP data just isn't what they would like for it to be. It wasn't as well managed. And so they're very excited about their post-ERP environment from a sales tax compliance perspective. And so they would love for the state to see that. But we really don't have a lot of control over that. So there's little tricks we'll try to play to try to influence the auditor towards one or the other. In one example I can give you, our client, this went back to, I think at the end of 2017, is when they implemented their new ERP system. The audit spanned 2016 to 2020. And so our approach was, well, here's the problem. We've got this legacy system where access to it is limited and challenging. And so for us to get any data prior to 2018 would take a number of months to get that for you. So we'd be happy to sign a waiver to allow us to gather that data and get that time. More often than not, the other side of that equation, I should say first, or I can give you everything from 2018 forward to look at, and I can get you that in a matter of days. So give them a choice. And I feel like anytime you're giving them a choice, they can feel like they have control, and their ability to feel that way will give them comfort. And so in that particular case, they chose to look at 2018 forward, and it was very beneficial for our client. and worked out very well. Sometimes we know something about our business, like that ERP example. Other times we've had sort of fluctuations in our business where there's been a big transaction that was very unique, an outlier. And certainly to the extent there's that sort of thing, we want to avoid sampling and projecting based on outliers. Fairly obvious to everybody, I think, that it's just a mathematical equation, but it happens more often than you would know. In fact, a lot of times if somebody's decided they want to manage their own audit, and at the end of that experience, they get their audit work papers, and maybe they've even gotten their final assessment, and they bring it to me and say, hey, is there anything you can do with this? I will immediately go to, what was the sample? How was it picked? How was it chosen? What were the projection methodologies employed? And then within that sample, let me see the strata that were used or selected for that particular exam. I find there to be a low-hanging fruit in mitigating audits just by trying to challenge either the sample or the projection methodology. I want to build some level of rapport with this auditor, and so it's not uncommon for us, knowing that there might be some significant risk in the underlying data, to disclose some elements of our risk. Things that I would look at and say, this is obviously going to be identified. There's no chance we're going to avoid it. Let's put it out front and in the open and spotlight it. So using my house example, I might have a real bad leak on one end of the house. And so what I might do is go into one of the bathrooms on the other end of the house, and there might be just a small little evidence of a prior leak. And I might point to that and say, this house isn't perfect. There's some elements here, and we wouldn't want you to be buying a bag of goods from us. We wouldn't say it that way. And point to that. Show a flaw. Show a few flaws, and it gets you immediate credibility to some degree. So it's not unheard of that we will actually lay out some of those problems. We had an auditor come in. I won't name the state. It was rather embarrassing for the state, but this client, it was a taxpayer that we did not represent prior to the audit, but this client calls us and says, hey, I got a real problem. I got the state coming in to audit me, and we have been based in that state for years, and we have never charged tax on our taxable services. It is of a magnitude that could bankrupt me. And so we actually spent a good bit of our time trying to figure out how were we going to avoid this. It just seemed too obvious to me that this was going to lead to a real issue. So my strategy was, let me show you all the dirty laundry. Let me give you enough information, and I don't want to use the hose technique, but I want to give you so much data that you're enamored by it and you can't not focus on it. There's too many variables that you're sort of perplexed by or engaged with. And so that's what we did. We just put all of this data in front of the auditor that really had nothing to do with the sales side of the business. It was the purchase side of the business. For whatever reason, I'm not going to suggest it was my ability, but the outcome was what we had hoped for. The auditor totally misunderstood the nature of this business. We confused him with our description of how it operated and what it did. And he, at that point, just left the sales side, the revenue side alone, as if it wasn't taxable. And they did such a poor job of really understanding the business that when the audit was starting to be wrapped up, the auditor reached out to me and said, hey, I've got to write a summary page of this company and my audit routine, and I'm really struggling with that. Could you help me write it for his supervisor to review? And part of me was excited by that. I was thinking to myself, well, this is great. I have control. The other part of me was like, well, I can't lie. So now I'm really in a position where I'm going to have to put pencil to paper in a way that's strategic enough to be successful, but not to dissuade or falsely state anything. So anyway, audits and auditors come in a lot of different shapes, sizes, and forms, some of which are better than others. It's not always true that a bad auditor or And I throw these terms and these adjectives around a little bit freely because I was an auditor, and I know how we were perceived. But you may have an auditor that's just not they might be a dull point. They just may not be the sharpened pencil in the pack. That may be a good thing, and it may be a bad thing. It's hard to predict whether a good auditor is smart or a good auditor is dumb. Either of those could be bad or good. So there's no real predictive index that we can employ in that regard. The other thing that I think is important to understand is, and I said it earlier, the audit's going to span a period of time. It's going to take a while. And so more often than not, our clients, particularly those that have customers who are exempt, will have inadequate exemption certificates on file to substantiate those exempt sales. And so as a result, we'll encourage them to leverage and use that time during the audit, the beginnings of the audit, to get data, to get exemption certificates, or to get what we refer to as an XYZ letter. An XYZ letter is a generic term. A lot of the states are familiar with it and use it, but it's an affidavit that you get from your customer that says, while we're not exempt, we did actually self-accrue and remit use tax on purchases from your company. And so we've already satisfied the sales or use tax liability. Or perhaps they've been audited for the same period that you're under audit. And that XYZ letter serves to explain that period and those transactions have already been addressed. So that's just what an example of an XYZ letter looks like. The managing the audit is as much managing the auditor. The relationship is key. I like to tell people, look, treat the auditor with respect. You're not going to get anything out of having a sort of cystic relationship with them. I do recommend highly you identify a single person to manage the audit from beginning to end. You've got to have a consistent sort of messaging that's going back to the auditor, particularly on how you answer questions and which questions to answer. Sometimes, like I said earlier, we manage a lot of audits for clients. I don't like to be in a position where I'm not managing the entire audit. I do have a client that's going through an audit in the Northeast at the moment. And what happens is they'll get a question from the auditor that I know how I could or would answer it. And I can tell my client how I could or would answer it. But my client being in the position they're in, they're not able to answer it the same way because they're in the business. They have the knowledge. They can't say they don't know, or they can't say that I think. They are expected to know. So I do tend to try to encourage clients to put someone in charge of the audit that's more executive level, not into the details, so that they can have the answer, I don't know, available to them. I think limiting the auditor's access to data and other people within the business is something we've kind of talked about at this point, particularly on the data side. I already mentioned, if I can, I'm going to get them stuff I want to show them in their hands quickly. I want to show an effort, an intent to comply. And it's okay, and I do this sort of strategically, I will ask questions during the initial part of the audit. I might do so even though I know the answers. Sometimes I'm wanting the auditor to have a perception that I don't have all the answers, that I don't know everything about their state tax policy. And I'm staging that specifically and intentionally so that I have a little more flexibility in the long run or at a later stage. It also can help me to do a couple of things. I can make the auditor feel a little more knowledgeable and maybe even superior, and give them confidence and show them gratitude in a way that makes them feel good about the relationship we've got. At the end of the day, these auditors have a lot of discretion, particularly at the very initial stages of the audit and during the assessment process. As the audit starts to near the end, they have a little less, if not a lot less, discretion. Where are we at the end of the audit process? A lot of the effort that I think is most valuable is in the upfront analysis, the preparation for the audit, the management of the audit. By the time you get to these late stages of the assessment, you start to get a little bit hamstrung and you start to get a little more targeted. So I think when we see this initial assessment come out, they can come out in two varieties. Most of the audits will come in what I call work papers. So it's a preliminary assessment, basically saying this is what we intend to assess you. Do you have any mitigating documentation or arguments that would support these being removed from the assessment? Along this time frame is when you're likely to get a request for a statute of limitation waiver. That's basically giving the state more time to assess you on these open periods. And you might be thinking to yourself, well, why would I ever sign that? Why would I ever give the state more time? More often than not, the advantage on the statute of limitation waivers is to the taxpayer. Sometimes we do find that auditors drag out audits and these things go on for years and they just keep doing these waivers, and that there's an end point to that you want to get some consulting support to help you out with that. Otherwise, I tend to find executing waivers to be okay, and that's basically, again, giving us all more time to evaluate the preliminary assessment. Once you get that assessment, hopefully you've got a little bit of a feel for where you're going to get hit, but focus on the large items, the large assessment categories. Some of us hate to pay $1 of extra tax, but as I used to tell my taxpayers when I was an auditor, if you have no liability and no risk, you're probably spending way too much time or money on your compliance. There's a balance. There's a cost-benefit analysis you got to do in terms of how accurate and specific you're going to be with compliance. So you should expect some level of risk and some level of liability. And it's at this point where we're able to then provide exemption certificates to the auditors. Most of the states, if you didn't have the exemption certificate at the beginning of the audit, most of the states are going to give you pretty good latitude to accumulate those exemption certificates while the audit's going on. We already talked about XYZ letters a few times. It's okay and appropriate, frankly, and it happens even in my scenarios. Sometimes I'll see the auditor assess something, and I think that they're really applying their own interpretation of law, and I don't believe it's accurate. So I ask them for their statutory support. Sometimes we'll go back and forth, and I'll convince them that their interpretation of the law in this particular circumstance is wrong. Sometimes we don't get to an agreement in that regard, but at least I know what their position is. And what I'm trying to figure out is exactly why they believe that assessment is accurate or that item's taxable. We talked already about projections, sample periods. You do want to pay attention to that. The more statistical, computerized sampling and projection methods they use, the more difficult it might be to challenge that. It doesn't mean you don't challenge it. You ask questions, understand it, make sure you're comfortable with it. There can be some negotiated settlements. They can come in a lot of different flavors and varieties. I do have clients that'll kind of convey to me that real flippantly that I just settled that audit. They came in and assessed me $100,000. I told them I was only paying $50, and we walked away with $50. That may happen. It probably doesn't happen that way. There's probably other factors that were involved. But there can be some negotiated settlements. There can be some give and take at the end of the audit. And it can be based on, ambiguous interpretations or ambiguous transactions in that regard. Once you get past that work paper, that preliminary assessment, you start to lose ability to negotiate with the auditor themselves. And now you're getting into more what I call an appeal type scenario. In a lot of states, that can be fairly informal. It can be simply meeting with that auditor's supervisor along with the auditor. You may come to some good conclusions that way. There might be an informal protest or hearing process that state has in place for you to execute. That's usually a next level up person that's going to evaluate the case based on what they have in front of them. Sometimes you can find yourself in a position to get more data and support that. Then you start to get in a more formal appeals where you probably want some level of external support, whether that be a consultant. Sometimes if you get to the court level, you're going to need an attorney. But it's just important to understand that you are afforded a number of different appeal levels and opportunities depending on your circumstances. So at the end of the day, back to the original slide, where I talked about just be ready, prepare yourself for the inevitability of an audit, and just do the right thing as best you can. Sometimes I have clients that they'll look at their use tax accrual side and they'll say, there's just no way I've got time or energy to focus on paying use tax on purchases that the vendor didn't charge me sales tax on. That's okay. I get that. I probably wouldn't do it either. I might consider, depending on the volume of that activity and the potential of that risk, booking an accrual in anticipation that I may owe something in some state someday. So having a little bit of flexibility in the financials to offset an eventual tax assessment isn't a bad idea. But this here is a list of just items to consider. Keep good records, understand statute of limitations, the 7 to 10 year look back period if you're not registered. So you want to have good records to substantiate your activities. And at the end of the day, if you don't have records, you can assume that the state's just going to assess it. It's going to become taxable. I was on the phone just this afternoon with another client. They're getting audited in Florida. They've got a $650,000 sales tax assessment. It's a preliminary assessment. And all it is the difference between their income tax return and their sales tax return revenues. They just have differences, and they're natural differences. They're things that almost every company has. They're reconciling revenue recognition type differences, usually fairly easy to explain away. But again, in the absence of the facts and the documentation for the auditor, you can expect it to be assessed, as ridiculous as it may seem sometimes.
Thank you.
Thanks, everyone.
This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. We'll see you next time.